Well, that's what we're talking about, cost segregation. Again, I'm Tony Bonifacich. I'm the Executive Vice President of MoneyQuest, and that'll come clear. Jim Shreve, the president of CSSI, was a guy that I tried to hire a few years ago, but he was involved in a project. Lo and behold, the engineer came up with something that was very lucrative. And to give you an idea, I think I might have right here let's see. Well, I'll come up with it later. But anyway, tried to hire him. Didn't work out so well because he was involved in a program where he was going back and forth to New York with the attorney that actually was involved with the case that broke this wide open for everybody. But real simple, we want to get started with a couple things, like what is cost segregation all about? And excuse me if I'm not a whiz here on this. I haven't worked with your program a bunch. But anyway, it's all about accelerating depreciation. Why do we want to accelerate depreciation? Because what it does is it increases your expenses, which decrease your taxable income. For every dollar that you increase your expenses, it's a non-cash expense, remember, you're going to go ahead and reduce your taxable income. When you reduce your taxable income, that means at your particular tax rate, typically about 36%, for most companies, you're going to wind up having a direct impact on your cash. Now, can I get rid of this up in the corner here? Can you see everything? Nope, don't want to do that. Anyway, this is a chart. I was trying to get rid of the thing on the right-hand side of the screen. But if you have a regular depreciation method where you're going with your typical standard depreciation, you divide a building by 39 years. The typical CPA says, okay, you got $1 million building divided by 39. They take about 2.56% per year for 39 years. Well, we understand that as of 1986, about 2 to 5% of a building could be component or compartmentalized, and that's what they would be able to put in, like furniture and fixtures, et cetera. Now, we're really not dealing with that. What we're really doing is separating structure from personal property. So if you look at a building, the shell of a building, the brick and mortar, is really 39-year property. Everything else that's included in that building, decorative moldings, flooring, HVACs, a number of different items, can be depreciated a lot faster. Now, understand, if you take a look at this graph here, that red line indicates a 39-year depreciation. It's straight line depreciation all the way across the board. They're getting at 2.56%. When our engineers break down a building and pull out a bar that can be removed or that decorative type information, specialty wiring for computers, etc., we wind up with anywhere from 20 to 45% of that building that can be depreciated in 5, 7, or 15 years. Now, we don't have a whole lot of 7-year, but the 5-year is personal property. The 15 is things like parking lots, landscaping, flagpoles, you name it. But just take a look at this chart. You're getting 25 to 45% of your building that can be depreciated. Say the 5-year, say if you have $1 million in 5-year property, instead of taking $25,000 a year, you get $200,000 a year. That differential of $975,000 times your tax rate of, say, 33% is $325,000 less taxes that you're going to have to pay this year. Now, what's really exciting about this, it's not only going to reduce your taxable income currently, it can reduce past taxes paid. So if you can carry back a loss, up until this year you could carry back a loss for 2 years, and now you can carry it back 5 years, which means you can reach back and get taxes paid back in your pocket. Now, I'm having a little difficulty with the screen here. Get back to here. Bear with me, folks. I'm a technical...
Yeah, one of the things I want to point out is that this is an open forum call, so as we're going through these slides, feel free to go ahead and type any questions you have in, and I'll make sure that I can get them over to Tony so he can give us his best answer. So once again, open forum call. As we're moving through the slides here, and you have a question, please, by all means, go ahead and type it in the questions box, and whenever it's convenient, we'll get you an answer. Okay, Tony, back to you.
Yeah, now understand, we're a marketing organization, and we are the marketing arm for CSSI. And our guys were out there, and that's why Jim and I got together. We had a marketing organization. He's an engineer. And when we talk to doctors or business owners, most of them own commercial buildings, or a very large majority of them do. So all we want to do is add one more question. So you guys are out there talking to building owners and property owners also. Do you own the building? You know, where you have your practice? Is this your building? Are you leasing, or what's the case? And then they say, well, yeah, I own the building. Why? Well, because as a commercial property owner, how would you like to receive cash flow from tax savings of 7 to 10% of your building costs within the first 5 years of ownership? That's $70,000 to $100,000 for each $1 million in building costs. Now understand, the prime candidate, a guy who's got a building that's like 5 or 6 years old, he gets the biggest bang for his buck that year, because what you're really doing is correcting depreciation. If you're taking 2.5% a year, yet you can take 20%. The IRS, when this case was won, gave a couple punitive measures to, I should say that the courts wound up developing a few punitive measures against the IRS for basically holding this information back. So they will allow you to take everything all in the current year. So if you bought a building in 2000 or even in 1990, all the depreciation that you didn't take can be taken in this current year. If you have income to be able to withstand all that increase in expense, you can take it all this year. So that's a primary motive, to find a guy 5 or 6 years old. However, if you find a guy with a brand new building, he gets the benefit from day one. He's not going to get that big slug of money in the first year as a guy who's got a building 5 or 6 years old, but he's going to get the benefit. He's going to be doing it properly, and he's going to be saving 18% approximately per year on all his 5-year property. But cost segregation is the answer to get that money back in his pocket. Now, as I was just saying, Jim was going back and forth to New York working with the attorney that won the Hospital Corporation of America case, who owed $800 million to the IRS. One month he went up to New York and he says, here, I got $1 million building. And the attorney looked at him like he was crazy. He says, $1 million building, we don't fool with that. So what he wound up doing is he went back home. His wife said, well, why don't you just do it? He said, well, that's not a bad idea. He did it. And he started knocking on doors and developed cost segregation services, where now we've done over 5,000 properties. So it's a pretty amazing process. And he started just like you and I, knocking on a door. He would go ahead and find somebody who owned a building. He'd explain the process to him. He said, well, let me do you a feasibility study for you. He did that. He took it home, came back and showed him the numbers, says, hey, that sounds like a great deal. What would it cost me? Well, you know, say it cost $10,000 to get $100,000 back. The guy said, sure. He went home and did the studies. As soon as he got done, he started knocking doors again. Anyway, we're going to talk about a number of different things, the definition, how it benefits the clients, how you're going to benefit, and why it's a perfect fit with any marketing activity, actually. It was great for us, and it'll be great for you. But cost segregation. It's an IRS-approved application to accelerate depreciation and reduce your taxes owed. The savings, as I said, as you increase your expenses, and they're non-cash, decreases your taxable revenue. As a matter of fact, I saved the company last year $5.3 million. They were pretty happy. They were paying, I think, $3 million a quarter for taxes, and they wound up getting it in the third quarter. They wound up paying $1 million in the last quarter. But it's a simple process, it's legal, and it's recommended by the 2004 Journal of Accountancy article. Now, this particular article is a key article when you're talking to people about cost segregation.